All right, good afternoon. Thank you all for coming. Well, we're waiting for my first slide to get going. There he is. What I'm going to do is quickly go through where kind of I think we are in this sector, and I don't think it'll be any surprise. So I'm just going to rip through that. Then we're going to do some real geology here, look at some projects, look at some ideas and how to evaluate things, because in my view, what is really important now in this stage of this market is there's a lot of stuff that's cheap, a lot of stuff that looks like it's worth buying, but there's very little room for error. So it's not just picking something that's cheap. It's understanding the basis of what this is being valued on, what the geology is, what the mineralization is, and what it might be worth. Because if you're wrong, you're going to be wrong for a long time. So the title of this is, could it get any better or worse than this? The answer is yes. And this is real quick. We all know this is a boom bust of commodity cycles, ex-oil since 1900 till about 2010, and it's continued on. It's just continued down from 2010. You could take this back to pre-BC to the salt trade in northern Africa. It's what commodities do. They're cyclical. They always have been. They always will be. We're in the down cycle. Where we are in the down cycle, I think this little clock gives a pretty good example of where we are. You can see crash at the top, boom at the bottom. If you divide that up, whoops, there's no pointer. We're about between 2 and 3 o'clock, which means things are still crashing. It's looking worse. It's hard to see when it gets better. This is the time to start doing your due diligence, start to buy these companies. I mean, I'm asked questions like, where are we, or how are things? Is it going to get better? And the honest answer is it really couldn't get much worse. We're down 90%. So that's my take. I don't know where we are in that cycle, but I think now is the time to begin looking and acquiring projects, companies that work. All right. This chart. Does anyone own this? Okay. This is 1996 to 2001. I want you to notice what's happened there. That just flatlined from 98 all the way out to 2001. This is a company that's actually presenting here, Nevison. It went from $17 to 10 cents. Things didn't work out in Africa. The cycle crashed. Here's Nevison from 2000 to 2004, 10 cents to $9. They made a discovery in Eritrea. Again, look at that long flatline period. Did it really matter if you picked the absolute bottom on this stock? Yeah. yeah. If you weren't going to live very long, yeah, you want to be more careful. It's like, yeah, buying a ripe banana. All right, so here's another company. Same quarter slide. What you see here is Altius Minerals. And I bring this one up because this is a company that started off at 25 cents, flatlined for a long time, and slowly got better as the market improved and got up to 28 bucks. What they did was follow a business model called the prospect generator model, which these three companies up here, plus Arena that presented earlier, are following. And I'm going to talk a bit about that model because I think in this sort of a market, it's one of the better, safer business models to invest in if you're into exploration, because what they do is they generate ideas, pick up projects, improve them to the point that it gets sexy looking to a larger mining company, and that mining company comes in, does the exploration. We know the odds of them succeeding on any individual project are very high, but in this game, it's about two things. It's about staying alive, perseverance, and time. It takes a lot of time to go through enough projects to finally come across the one that works. So we want to own a company that recognizes that and that can stay alive long enough and not dilute us out of what we own in the company so that when that discovery does happen, we profit. Another one, Virginia Mines, prospect generator model. Here you can see what happened from 1903 to 2006 when they discovered and sold Eleanor. 3,500% gain here over that time frame. And they followed the project generator model. I think one other thing that I like about this model is most of the guys that follow this model are really, really good geologists. And they recognize that most of what they're going to find is they don't know. But if you burn through enough projects, eventually you come across one that just keeps getting better. And when that happens, you've got a tight share structure and you're able to advance it yourself. And as shareholders, we get the chance to take 100% of it. That is what, to me, is the real advantage of that business model. Kemenak, same thing. 2005 is when they got up running. Prospect generator model. They generated a bunch of ideas in Canada. None of them worked. Finally, they came across the coffee project in the Yukon, and soil sampling looked pretty interesting. They did some trenches. I went up there and saw the trenches at that point, and you could see this is actually getting better. We're getting more and more certain there's something there instead of less and less. And they made that discovery. And the second point of this is look where it is now. Since then, they've drilled out 3 million ounces. You saw the presentation earlier. They've got a feasibility that shows a 50+% IRR at today's gold prices, and you can buy it at this price. Think about this flat line again, and when people start recognizing, when the majors start recognizing that there are so few of these really quality deposits, this will be worth a lot. For instance, First Quantum, another one. Flatlined, good geologists, good engineers. They built a small mine in Zambia and advanced it from there. This thing went up to $108. You don't need many of these. So anyway, that's where I think we are, somewhere on that flat line. So how bad is it, really? How are mining companies reacting to the current situation? I think this is a real important point because it plays into where it's going. What they're doing, they're cost cutting. Everywhere they can, these mining companies are cutting costs. They're stopped building mines. Capex is down 40% 2 years ago, another 30% in 14, and probably about the same in 15. They've slashed exploration. We know that. Budgets are way down. There's very, very little solid exploration going on out there. They're cutting sustaining capex. Think about that, sustaining capex. That's what you use to sustain your business. So they're not sustaining their businesses even. They're cutting dividends and they're high grading their deposits. And I'm going to show a slide of what that really means because this is an important aspect as well. When you high grade a deposit, the top slide shows, and this is a real life example in West Africa, shows the deposit and the resource, the reserve as it's been drilled out and how they were going to mine it, with the red being the higher grade and the orange being the lesser grade. What they've done to high grade this in order to bring more cash to the front is they've modified the mine plan to only go down on the high grade. So they ripped that out, which improves their costs, lowers their costs, improves their profitability, which means they mined 2.8 million ounces at 4 grams. But what's happened is they're leaving behind 1.2 million ounces at a grade of 0.9 grams. That is now economic. So not only have they're destroying their future profitability, their mine. They're ruining their deposit. Real important point there. So we're going to do more geology here. But first, let's look at gold. Okay, I think we all know this. This is gold discoveries over time since, looks like 1990. It's obvious what's going on. Real discoveries are down. Those are ounces by year, as well as towards the end there, you've got projected ounces that have been discovered. That gray line running, or the brown line running across there, that's annual production, about 90 million ounces. What that arrow points to is the gap between what we're producing and what we're finding. So we're producing 40 more million ounces a year than when we are actually finding. That can't go on forever. All right, so let's find more ore. But let's look at some modern realities of exploration. In general, you can say, and this is a study Newmont did, 1 in 1,000 prospects turn into a mineable deposit. And in fact, 1 in 10,000 prospects end up being a tier 1 deposit, which is what we really want. A tier 1 deposit being something that lasts for 20 years and makes money. And roughly, and I hope this makes sense, for every one deposit that grades 2.5 grams per ton, Mother Nature made 10 deposits that grade 1 gram per ton. Now, if you have a 1 gram deposit at the surface, that works, but there are very few deposits sitting at the surface anymore. So what's happened is we're drilling down beneath cover, blind, and we're still finding for every one 2.5 gram deposit, 10 1 gram deposits. Those are no longer economic. So our success rate is declining as well. So we're not, the odds that we're going to find enough new gold to replace with mining is getting worse. I guess that's the point. All right, so I went through 135 deposits that are put out by SNL in a database. And from that, I pulled out the ones that were held by a single company. The companies that held a single deposit, because that's what I was looking for. And then in yellow, I put on there the ones that I think probably make money. And you can see there's Volta Grande, the DNA's deposit, Dalradian's deposit in Northern Ireland, Coffee, Kamenex, Golden Meadows down in Idaho that Midas Gold has, Orzone's deposit, Bruce Jack probably, and Back River. That's not very many out of 135 deposits, in my opinion. Most of what we're finding, and this goes back to what I said, is marginal to sub-economic. And I went through and, okay, so what's the net present value of these deposits based on their studies, economic studies? 25 billion. The capex of these companies is about 20 billion. Oh, sorry, the capex to build these deposits is 20 billion. And the combined market cap of all these companies is 2 billion. Now, how does a 2 billion market cap company raise $20 billion? It's just not going to happen, I mean, in general. And if you take out a couple of these companies, the market cap is much less than that. So anyway, it's not feasible right now for these companies to raise the money to build these things, even if they were economic, and most of them aren't. All right, so this is the important bit. As speculators in this industry, knowing the odds of success are so poor and that it costs so much to find these things, my job, what myself and Joe do in our letter now, is really, it's all about killing these things as quickly as possible. And this is what mining companies, exploration could be doing as well. We know most things are going to go wrong, so our job is to say, as quickly as possible, this isn't going to work because of X, Y, or Z. If we can't find the X, Y, or Z, that's great, but normally you do. You need to know what it's going to cost to bring these projects forward versus what the company has in terms of their cash in the bank. Okay, how are they going to get there? What's going to make, what's going to bring them new money in at a higher price, hopefully? You need to know the go, no-go decision points. That's really important. Know the geologic parameters, the economic parameters behind the deposit. If you're looking for a volcanogenic massive sulphide deposit, what is it going to take to the capex to build it, if it's underground or on ground? What's the metallurgy likely going to be? What's it going to cost to build that thing? What's the infrastructure going to be? So when I go to a deposit, and Joe does this as well, the first thing I do when I look at a rock is start looking around and say, okay, how much is it going to cost to get here? How are we going to get the gold out of this thing? All these costs got to come into that very first on, because most of these aren't going to work. Social environment, those issues. And finally, does it translate into a share price increase? So many of these companies, even if they're successful, what they're successful finding really doesn't matter. All right, evaluating heap leach deposits. We're going to go into this in a bit of detail. And this is a study that Joe did and put out in a report we did 2 or 3 weeks ago. And he compiled all the heap leach deposits and their grades and such. And when you've got a heap leach deposit, and we're going to go into, and I'll say what the conclusion was basically, it needs to be simple. And if you're looking at something under 0.6 grams per ton, 665 grams per ton, you better be aware. If that's going to work, it has to be special. It has to be not require a couple stages of crushing. It has to be at surface. The metallurgy has to be good. Once it gets beneath that, you better be careful. So not many make it above that. You can see Long Canyon does, Coffee, Mascota, and Karma. Those are the ones that make it above there. So what is a heap leach deposit? Basically this, you blow up the rock, you crush it to some degree, put it on a heap leach pad, and you sprinkle cyanide across it. That cyanide drips through the rock, leaches the gold, and takes it down in the fluid, and then you recover it out of that fluid. Why these things are so important or so much easier to develop is that normally gold occurs inside of some sort of iron. So to get the iron out of that, you've got to break down the pyrite, for instance. With a heap leach deposit, with an oxidized deposit, Mother Nature has done that. She's taken the pyrite with the gold in it and turned it to rust. When it turns it to rust, the gold is free, so it's much easier to leach. So that's really important. So what we're doing here is we're leaching the ore. And this is what a heap leach pad looks like. So you can see the sprinkling comes down on top. That's the blue lines. It leaches through the pile and collects the gold. Now there's lots that can go wrong in these piles. If there's too much clay in them, the water gets stuck into a channel and doesn't reach all the particles of gold, so your metallurgy goes way down. There's a lot of issues with this. And that's what you've got when you're doing these studies, when you're doing your due diligence. That's what you've got to focus on, the details. All right, and then there's this transition between oxidized rock and sulphide-bearing rock. The sulphide rock, where the gold is in the sulphide, cannot be leached, or normally cannot be leached with those heap leaches. So it doesn't leach. Now, if the one slide where the guy's on the ground, it's not hard to figure this out. The oxide rock is all the red stuff above him. The sulphide rock is that grayish sort of rock beneath him. That's the contact. The rock above him will leach. The below it won't. The slide on the other side, I show a picture of an actual outcrop in the transition zone. So you can see the orange, again, that's the oxidized rock, and we're generalizing, but that's the oxidized rock. Where I put those circles, that's the sulphide-bearing rock, where the gold is tied up in the pyrite. What happens when you get into that zone, you pull it up and you throw it on the heap? All that gray stuff is not going to leach. So your oxide recovery is 75%, but getting the gold out of the sulfide, you get 40%, so your net recovery is 57%. If that's what's sitting on your heap leach pad and your economic study said you're supposed to be getting 75, you're getting 57, it doesn't work. I would say Midway falls into that category. More or less. More or less. All right, another one. Looking at results. This is one I like to use. In Peru, a company called Condor put out a news release, 174 meters at 4.4 grams per ton. This is what it looked like. This is their geophysical study. You can see down there that where the blue circle is, that's where that great hole was, and it rocked the stock. But they pointed out there had been other drill holes done there. And if you went back and went through the 43101 report, you can see that, again, that blue circle, what they've drilled is a relatively small breccia pipe, 75 meters across, that went straight down. And let's amplify that. So these are the old holes from the 90s into that same breccia pipe. So we knew what this was all about by going back and looking at the previous studies. So did the company know what this is about. So their hole went right down this thing in something that looks like it had probably 8 holes into it already. There was no new news here, and this thing was confined. But you can see what happened. The excitement, people didn't go and do their due diligence, and reality sets in. This isn't hard to figure out. You just got to spend the time to do it. Rubicon. It's the geology, stupid. I've covered this a few times now. And what I'm showing here is a section through the ore deposit with all those lines coming at it. Those are the drill holes into the deposit. On those drill holes are the assays. And they go, and you can see the scale there from 1 gram to 10 grams, 3 to 10 being the yellow. Now this deposit graded 9 grams a ton. So what we really want to look for is all the stuff that's red and above. And you can see that it's scattered through there, but you cannot connect hole to hole those high-grade intersections. And that was the problem at Rubicon. Here's another one, same sort of section. This is, now they've broken it down into blocks. Now, the deposit grades 9 grams a ton. Your cutoff is 4 grams a ton. So everything basically green and below is really not ore. You lose money mining it. It's waste. But look how much red there is in there. Those few red intersections, those blocks, are what carried the deposit. And I'll show you another slide. So here's what they do. Normally, when you're doing a model, you take all your assays, you throw them into bins by grade. And what I want to point out here is those are all the assays. I showed you where the 10-gram bin is. To the right of the 10-gram out towards where it goes 1,000, this is log scale, there are very, very, very few high-grade hits out there. So what happened is they smeared or spread these high-grade hits into zones of the deposit that were not economic. But we could see this. I mean, you could go through the report and you could kind of see this was what was going on. And they said as much. I don't know if I should bother reading this. Basically, the mining group, engineering group, will use these block models to design stopes associated with development to support mineral reserve estimation and the long-term production plan. Once the design of the stope group has been finalized, the 3D shapes will be used by the short-term mine planners to prepare detailed layouts for stope development. What they're telling you here is they really don't know what's going on in there. They got to get down there and look at it. Next paragraph. A few cycles of reconciling of the actual mining results with the block model predictions will help refine this method to give a reasonable estimate of future production. So they're saying, we don't know what's down there. You guys go down there and figure it out. And finally, the process could take more than a year to complete from start of definition drilling to start of development. These are all red flags. We knew this was coming. All right, takeaways. That guy with his head in the ground, that's your corporate president right now. That's about all the money they've got for exploration. So mining's cyclical. Discoveries and exploration are collapsing. Supply is not going to meet demand. I don't mean what I mean in terms of we're mining 90 million ounces a year. We're finding 40. It's taking 5, 10, 20 years to put a discovery into production. It's just not going to work. And that's fantastic for those of us that can identify the projects that make money and will be acquired by larger companies. And finally, own the best and cut the rest. It's not that hard these days, I don't think, to identify the companies that have something of value and to follow them in enough detail to know when things are going wrong and get out of the way. When things start going wrong, sell. So I think, I don't have a timer here, so I'm going to guess I've got time for a few questions from the audience. I want to do that because I went into a lot more technical detail with you all because I think you're a much more educated crowd in terms of mining and exploration and geology. So I hope that was helpful. Are there any questions from the audience? Yeah, way back there.
Brent, when you were talking about RMX there and the continuity in in those high-grade lens, or those high-grade systems, how big of a lens do you need at that high grade in order to have something that's going to make you money?
Well, that really varies. It really varies. How big of a high-grade lens do you need to make money? What you really need is a high-grade lens that shows good continuity over a long enough distance that you can come together with a resource.
How big of a lens are you talking about in that kind of a system to mount?
Well, your minimum mining width is going to be, depends on where you're at, but I'll call it a meter minimum. 2 meters is probably more reasonable. So if it's this wide, if your vein is this wide, and let's say it averages an ounce, you've got to mine a meter. That extra 90 centimeters grades 0, so your ounce just went down to, help me here, Joe, a gram? 3 grams, right. So you see what's happened? All of a sudden, when you're mining your ounce, you're mining 3 grams with dilution. But you need, that's a question that just varies by deposit. Yeah, I would say minimum, you want a minimum meter. The stuff in that Dalradian's got in Ireland, Northern Ireland, it's thinner than that. And they dilute it down to a meter, 2 meters, I think it is. And then that's the grade that they use. So you want underground mining. I like to see minimum, depending on, there's too many factors, but depending on grade, thickness and mining costs and that, 6-7 grams.